The markets are cracking. But here's what most people don't realize. Those cracks might be exactly what the Federal Reserve has been waiting for. After months of hawkish posturing, inflation targeting, and repeated warnings, the tide may finally be turning. The question now isn't whether the Fed is ready to cut interest rates. It's whether the cracks in the system are already forcing their hand. Let's be clear. The Fed has a dual mandate: price stability and full employment. But lately, it's been walking a tightrope between crushing inflation and avoiding a deep recession. And now, after holding rates above 5% for over a year, pressure is mounting on every side of the economy. Stocks are sliding, real estate is slowing, and Treasury yields are sending signals that can't be ignored. The signs are everywhere. Unemployment, once steady at historic lows, has started inching up. In May, the jobless rate tipped to 4.2%. Payroll growth has slowed. Consumer confidence is weakening. Credit card delinquencies are quietly rising. Corporate bankruptcies have doubled since last year. And behind the scenes, regional banks are starting to wobble again. This is not the economy the Fed forecasted, and they know it. But the real turning point came in the bond market. Over the past month, the 10-year Treasury yield has dropped sharply. That's not optimism, it's fear. Investors are buying bonds not because they believe in recovery, but because they're bracing for impact. And the futures market is now pricing in a nearly 70% chance of a Fed rate cut by September. So what changed? Why now? It starts with inflation. Core CPI for May came in at just 2.4% year over year, the lowest in over 3 years. Producer prices are flat. Rent inflation is finally cooling. And oil has failed to break above $80 despite OPEC's best efforts. In other words, the inflation war may already be won. But here's the twist. The Fed can't admit victory too early. They're still scarred from the 1970s. If they cut too soon and inflation rebounds, their credibility collapses. That's why Powell and company are talking tough in public, but quietly preparing to pivot in private. This is how the Fed moves. Not with headlines, with signals, with language, with market guidance. And right now, the language is shifting. In the latest FOMC minutes, there were hints. Mentions of economic fragility, concerns over tightening credit conditions, repeated references to data dependence. This is Fed speak for: we're watching, we're worried, and we're ready to move if needed. And the timing matters. Historically, the Fed cuts rates only after markets start to break. And that's exactly what we're seeing now. In the past 30 days, the S&P 500 has dropped nearly 6%. The NASDAQ is down over 9% from its April highs. Bank stocks are bleeding. Commercial real estate defaults are accelerating, and consumer spending is beginning to stall. This is the quiet unraveling. It's not a crash. It's a slow-motion reset, and it's creating the perfect pretext for a rate cut without admitting defeat. Because make no mistake, the Fed doesn't want to spook markets. They want a controlled descent, a soft landing. But soft landings are rare, and this one is already getting bumpy. The deeper reason this matters is leverage. The U.S. economy is now sitting on over $36 trillion in national debt. Interest costs have crossed $1 trillion per year. Corporations are swimming in junk-rated debt, and consumers are maxed out. In this environment, even a small rise in defaults can trigger chain reactions, and the Fed knows it. That's why they're watching not just CPI, but credit spreads, delinquencies, repossession data, bankruptcy filings, all the shadow indicators the mainstream never sees. Now, here's the opportunity. If the Fed cuts, whether in July, September, or October, it will be a massive inflection point for risk assets. Equities could spike, bonds will rally, gold may surge, and dollar strength will likely weaken. But the bigger move will be in volatility. Traders who position early, before the headlines, stand to gain the most. That's why the smart money isn't waiting. They're already reallocating, rotating out of crowded tech names, getting into oversold sectors, building gold exposure, and re-entering bonds. But what about the risks? What if the Fed waits too long? That's the real danger, because every day they delay, the cracks grow. More layoffs, more defaults, more volatility. And if something breaks, another bank failure, a credit event, or a sovereign shock, the Fed will be forced to act reactively, not strategically. That's why this window is critical. The time to position isn't after the cut. It's before the pivot. Let's talk timing. The next FOMC meetings are in late July and mid-September. Barring a major shock, July will likely be a hold, but September is live, and markets are already leaning in that direction. Fed funds futures show a 68% probability of a cut by September. That's not a guess. That's real money betting on a shift. And with inflation softening, labor showing cracks, and financial stress rising, the Fed has every reason to cut without admitting failure. They'll frame it as a normalization, a recalibration. But make no mistake, it will be a lifeline for the system. This is why gold is quietly climbing. It's why the dollar index has stalled. It's why smart traders are loading into bond ETFs, inflation-protected securities, and oversold sectors like utilities and healthcare. You don't have to predict the Fed. You just have to interpret their fear. And right now, that fear is growing behind the scenes. Remember, markets don't wait for confirmation. They move on expectation. And the expectation is shifting hard toward easing. If you're serious about wealth building, this is not the time to sleep on macro conditions. This is the moment to sharpen your edge. Study the data. Watch the language. Track the flows. Because when the Fed finally moves, the opportunity will already be priced in. Don't be late to this. To understand the Fed's next move, you also have to understand the politics. Rate cuts are never just about numbers. They're about timing, optics, influence. With a presidential election approaching, the Fed is under pressure to avoid appearing partisan. But if economic deterioration accelerates, they may be forced to act regardless of political narratives. And that's where the window opens for investors paying attention. Rate cuts, when timed correctly, have historically triggered powerful reversals across asset classes. The 2019 rate cuts, for instance, preceded a massive equity run-up. And in 2007, the Fed's early easing sparked temporary rallies, even as broader risks loomed. We're at a similar crossroads now. If you position correctly before the pivot, you gain the leverage of momentum, not just reacting to change, but profiting from it in real time. Even more critically, you avoid the trap most investors fall into, chasing moves that are already priced in. Because once Powell says the word cut, you're already too late. The smart money will have moved weeks earlier. This is the psychology of front-running macro policy. It's not about guessing dates, it's about pattern recognition. Identifying when narratives shift, when data breaks trend, and when silence starts to speak volumes. One more signal worth watching is liquidity injections. Quietly, the Fed has allowed its balance sheet runoff to slow. Repo activity is rising, and Treasury auctions are being supported more aggressively. These are soft pivots, technical signs that monetary tightening has likely peaked. So what do you do with all this? Build asymmetric positions. Allocate toward assets that benefit from falling yields, long-duration bonds, quality growth stocks, and yes, precious metals like gold and silver. Reduce exposure to over-leveraged sectors like commercial real estate or speculative tech with poor earnings. This isn't a time for gambling. It's a time for precision, a time to follow signals, not noise. Because the opportunity ahead isn't just about recovery, it's about repositioning for the next cycle entirely. Subscribe to Wealth Signal now so you never miss these moments, and learn how to front-run the next major shift before it hits the headlines.